It's 6:47 a.m. on a Monday. A portfolio manager in Manhattan hasn't slept. Her Bloomberg terminal is cycling through screens she's memorized by heart, and in 13 minutes, Goldman Sachs will release numbers that could move billions. This is Money Moves Daily, and today we're decoding what Wall Street's report cards actually tell us about the economy, about interest rates, and about your money. Here's the thing about bank earnings. They're not just numbers on a spreadsheet. They're a real-time X-ray of the American economy, consumer spending, business confidence, whether your mortgage rate is going up or down. And this week, 6 of the biggest banks on earth are opening their books: JPMorgan, Goldman Sachs, Wells Fargo, Citigroup, Morgan Stanley, Bank of America. All of them, all at once. The financial sector is expected to post 15.1% earnings growth this quarter. That's the third highest of any sector in the S&P 500. But what does that actually mean for you? Let's start with why bank earnings matter so much. Banks touch virtually every aspect of financial life. Your checking account, your mortgage, the loan your employer took out to expand the business that pays your salary. When JPMorgan reports strong numbers, it's not just good news for Jamie Dimon's shareholders. It's a signal that consumers are still spending, that businesses are still borrowing, that the economic engine is still running. And when banks struggle, that's often the first warning sign of trouble ahead. They see the stress before the rest of us feel it: rising delinquencies, slowing loan demand, defaults ticking up. So this week isn't just about 6 companies beating or missing their quarterly targets. It's about reading the tea leaves of what's coming next. Now let's look at the numbers. According to FactSet, 75% of S&P 500 companies reporting this week are from the financial sector. That's 21 out of 28 companies. This is Bank Earnings Week, the Super Bowl of quarterly reports, and the financial sector is projected to deliver that 15.1% year-over-year earnings growth, outpacing most of the market. Let's start with the biggest name in banking. JPMorgan Chase reports Tuesday morning at 7 a.m. Eastern. Analysts expect earnings per share of 5.46 cents. That's a 7.7% increase from last year. Revenue is expected to hit $48.56 billion for the quarter, up 7.2% from Q1 2025. For context, that's roughly the GDP of Costa Rica in one quarter. From one bank, Goldman Sachs reported this morning, their investment banking fees are projected to reach $2.5 billion, a 30% jump from last year. That's a signal worth watching. Why does investment banking revenue matter? Because it tells us whether companies are doing deals, mergers, acquisitions, IPOs. When businesses are confident, they buy other businesses. They go public. They raise capital. A 30% surge in investment banking fees suggests corporate America is making moves again. After 2 years of relative quiet, the deal-making engine is revving back up. Now here's where it gets interesting for interest rates. The Federal Reserve held steady at 3.5% to 3.75% in March. That was the second consecutive meeting with no change. The vote was 11-1. Only Governor Stephen Moran dissented, pushing for a quarter-point cut. Everyone else said, not yet. Hold the line. But look at the dot plot. That's how Fed officials signal their rate expectations. 7 members see rates unchanged this year. 7 expect 1 cut. 5 think we'll see more than 1. Translation: nobody agrees. And that uncertainty, that's actually useful information. It tells us the Fed is genuinely data-dependent, waiting to see what unfolds. The Fed raised its GDP growth forecast for 2026 to 2.4%, up from 2.3%. Not a huge move, but in Fed speak, even tiny shifts matter. But here's the catch. Core inflation is now expected to end 2026 at 2.7%. That's up from their December projection of 2.5%. Inflation is stickier than they'd hoped. So what does this mean for bank earnings? Net interest income, that's the money banks make from the difference between what they pay depositors and what they charge borrowers. When rates stay high, banks generally make more on loans. But if rates stay high too long, people stop borrowing. It's a delicate balance. Options markets are pricing in a 3.87% move for JPMorgan stock after earnings. That's higher than its typical 2.71% post-earnings swing. Traders are expecting volatility. Now, volatility isn't inherently good or bad, it's movement. It's uncertainty resolving into certainty, and for investors with a long-term horizon, volatility can create opportunity. Here's where I need to be careful because this is where people get burned. Past patterns don't guarantee future results. What happened last quarter or last decade might not happen again. So what should you actually pay attention to when these earnings drop? Here's a framework that might help. First, listen to the commentary, not just the numbers. CEOs like Jamie Dimon often provide candid economic assessments. Their forward-looking comments, that's frequently more valuable than the backward-looking revenue figures. Second, watch the net interest income trends. Banks make money on the spread between deposit rates and loan rates. If NII is growing, your savings account APY might not improve anytime soon. Third, track investment banking revenue as a leading indicator. Strong M&A activity and IPO pipelines typically precede broader economic confidence. It's corporate America voting with their wallets. There's more to that's worth knowing. Geopolitical tensions, including the ongoing situation in Iran, have added uncertainty to bank outlooks. Energy disruptions affect everything from shipping costs to consumer spending. When oil prices spike, transportation costs rise. When transportation costs rise, everything costs more, and when everything costs more, the Fed has to think twice about cutting rates. Analysts noted that for investors looking to navigate geopolitical uncertainty, the upcoming earnings season will be key. Energy disruptions are likely to continue, making diversification important. Here's the honest version. Nobody, not the Fed, not Wall Street, not your favorite finance podcast, knows exactly what rates will do in 6 months. What we can do is look at what the data has shown historically, with the full understanding that history rhymes more than it repeats. Patterns are not predictions. If you're considering a major financial decision, a mortgage, a business loan, refinancing, pay attention to what banks say about credit conditions. Are they tightening standards, loosening them? That forward guidance in earnings calls can signal whether banks are getting nervous about defaults or whether they're hungry to lend. Both matter for your financial planning. The financial sector's 15.1% projected earnings growth suggests underlying economic resilience. Businesses are still making money. Consumers are still borrowing and spending. The wheels are still turning. But, and this is important, always verify forward guidance against backward-looking results. Strong earnings today don't guarantee strong earnings tomorrow. Management's tone matters. Here's something practical. The expected 3.87% post-earnings move in JPMorgan stock represents potential opportunity, but only for investors who've done their homework and have a genuine long-term horizon. Volatility creates opportunity for disciplined investors, but the keyword is disciplined, not reactive, not emotional. Disciplined. Know your thesis before the numbers hit. Now, your situation is specific to you. Your risk tolerance, your timeline, your tax bracket, all of these change the math. What works for a 25-year-old won't work for someone retiring next year. Consider speaking with a qualified financial advisor who can apply these broader market signals to your specific circumstances. Macro trends matter, but so does your micro situation. If this kind of analysis is helpful, consider subscribing. We break down these market signals every week, translating Wall Street jargon into plain English so you can make smarter decisions. One more thing to watch. The Fed noted that officials are trying to navigate two-sided risks as persistent inflation and a softening labor market complicate efforts to ensure price stability and full employment. Two-sided risks. That's Fed speak for we could be wrong in either direction. Cut too soon, inflation roars back. Wait too long, the labor market cracks, they're walking a tightrope. Markets originally priced in 2 rate cuts for 2026 back in January. Now expectations have dropped to 1 cut, or possibly 0. That shift affects everything from mortgage rates to bond yields. So when JPMorgan and Goldman release their numbers, listen for what they say about rate expectations. Banks have skin in this game. Their profitability depends on where rates go. Here's a framework you might find useful. Treat bank earnings like a weather report for your financial decisions. Are conditions favorable for buying a house, taking on business debt, locking in a CD rate? The data won't tell you exactly what to do, but it'll tell you the conditions you're operating in. And that context? That's what separates informed decisions from guesswork. Remember, 15.1% earnings growth sounds impressive, and it is, but that's a backward-looking number. The real story is in the guidance. What do these banks see coming in the next quarter? The next year? So here's what we know. This week, 6 of the world's largest banks open their books. The financial sector expects 15.1% earnings growth. The Fed is holding rates steady while inflation proves stickier than hoped. JPMorgan is expected to post 5.46 earnings per share, up 7.7%. Goldman's investment banking fees could hit $2.5 billion, a 30% surge signaling renewed corporate confidence. What does this mean for you? Watch the commentary, track the guidance, use these signals to inform, not dictate, your financial decisions. And remember, this is not financial advice. I'm bringing you Money Moves daily. Thanks for listening. And remember, your financial future is built one informed decision at a time.